Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 30th, 2024. How you doing? Thank you so much for coming and visiting me for my weekend review podcast. I hope you're having a good weekend. I am back from Colombia after 3 months. I had a great trip, and if you're ever thinking about going to Colombia, visiting Colombia, I was in Santa Marta for 3 months. What a great, great city. Just so beautiful and very friendly people and a nice, relaxed vibe. And I couldn't recommend it any more higher than I am. So if you're in the mood for a warm, tropical, friendly, relaxed place, Santa Marta, Colombia, um, comes highly recommended. So, all right. Like I said, thanks for visiting the podcast. In this podcast, this is what we're going to cover today. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, both on the daily charts and the weekly charts. We're going to talk about when I entered the trade, why I entered the trade, what I was thinking, what the strategy was, what were the confluences and combinations of indicators that made me decide to enter the trade. We're going to talk about where my end of day stop is going to be. We're going to talk about where my emergency stop is going to be. We're going to talk about how I take partial profits if the market moves in the direction that I want it to, up if I'm long. We're going to talk about when I go into trailing stop mode and what is that, and how I tighten up my stops once we get to that level. We're going to talk about some serious overhead resistance levels, 70 RSIs, and 5 EMAs if we get to a certain RSI level. But yeah, we'll just talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade going forward. The most important part in trading for me is that I really need to have a process. I really need to have my process tell me what to do. And it makes trading much, much easier if you have a plan. If you don't have a plan, in my experience, it's very difficult to make money in trading because you can make impulsive decisions. You can have a big day up and say, oh, okay, that's good enough, I'm done. And then it runs up for the next year. For one example, one trade I have, I'll show you XLF. I mean, it's gone up for a year straight. And if I didn't have a process, I would not have enjoyed the benefits of that trade. It doesn't always happen like that, but get yourself a process. Be patient. Wait for a confluence or combination of signals to get you into the trade. Position size correctly based upon your account size and the volatility. Make sure that you have a good risk to reward ratio and know what to do with it to the upside. Let your process tell you what to do with through the process. It's a much more holistic way to trade, and in the long run, you're going to make a lot more money. So I'll show you all my trades, and I'll show you exactly the process that I'm using. After that, we're going to talk a little bit about trader psychology. Most important skill in trading. That is the skill to follow your process. And I always like to teach it. I hope it's helpful for you to hear it. And then after that, I have gone down through my master watch list. Did that last night when I returned home from Colombia. And I like to do this on the weekends. I go through the whole watch list, both on the daily time frames and the weekly time frames. And I identify some levels for next week. And I'll say, okay, if it gets to these levels, these make sense. There's combinations, there are major support levels. If they get there, I will consider taking the trade. If they don't get there, then I'll just go on and wait for another market that does get there. If when I look at a chart, I go, oh, look at this down here. It has this and it has that and it has this. Boy, I would like to buy it down there. Well, if it gets there, then I'll consider it. Let the trade come to you. Let the trade come to what makes sense for you. And for me, it's serious support levels like the 200-day moving average, the 250-day moving average, the 300-day moving average, the 30 RSI, looking for V1s, V2s, just as many different indicators lining up at the same time will really improve your chances of having a profitable trade. It doesn't mean it has to be a profitable trade. Certainly, you can have the best setup in the world and it still can fail. And that's when your position sizing and your stops come into play. All right, so I have identified some both on the daily and the weekly. I'll go over those. I'll show you what I'm looking for and what I'm waiting for before I consider taking that trade. I have to wait for it to get to where I'm looking for it. And that doesn't guarantee that I'm going to have a winning trade, but it improves my chances. And that's all we can do, is improve our chances. All right. So let's get started. Let me run the U.S. legal disclaimer. We'll get that out of the way. Hang tight for about 42 seconds, and I'll be right back, and we'll get started. Thanks a lot.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding through that with me, and let's get started. First on deck of my current trades is Rio, R-I-O. I bought Rio back here on the 29th of February. Why? Well, you can see the highlighted bar highlighted in blue. This is what is called an abandoned baby. So I bought it on the 29th. On the 28th, we gapped down, and then on the 29th, we gapped up. So what it did is it created what's called an abandoned baby. Abandoned baby is when 3 bars, basically bar 1 gaps down. You can see overnight in the morning it gapped way down, and the sentiment for this particular market was very bearish. But then the very next day it completely did a 180 and went up. So bearish, down, very next day up. I have noticed when you have bearish one day and then immediately reverse back up by very bullish sentiment, this can possibly, more times than not, be a short-term bottom. And so it's called an abandoned baby because this bar is just kind of hanging here by itself. So gap down, gap up. One of the strongest places to buy an abandoned baby is, you see how we gapped up and then we came down and we filled the gap to this abandoned baby, and that's what I waited for. I got long here at 61.78. So abandoned babies, island reversals, they're basically the same thing. Abandoned babies are just 1 bar. Island reversals are 2 or more bars. On these particular trades, my strategy, my profit and loss strategy, is a little different than the rest of my trades. I basically just set a 2 ATR stop down here. This is the red line if I'm wrong. And the green line up here is a 4 ATR gain. So in trading, you always want to have asymmetrical risk to reward, which basically means if you're right, you're going to make more than if you're wrong. I could certainly be wrong on this trade, and if I am wrong on this trade, I'll lose 2 ATRs or I'll lose 1% of my capital. If I'm right and it goes up 4 ATRs, then I'll make 2% return on my capital. Okay, so I'm risking 1% of my capital to make 2% of my capital. Most of my trades I scale out of. I'm a lot more active with them. But with these abandoned babies and island reversals, they're so strong that I want to have a little bit longer outlook and kind of let it do its thing. Either make 4 ATRs or lose 2 ATRs. Currently, the trade is up 3.12%. You can see I came here, bought, we went up, when we went down, I went, uh-oh, then we went way up, and I was like, oh, I got it, and then it went down, I'm like, oh, I don't have it. And so it's been pretty choppy, but the good news is the trade is positive, and if we get up to 4 ATRs, I'll just go ahead and take the profit. If we get down to 2 ATRs on my loss, I'll just go ahead and take the loss. But this one doing quite well, up 3.12%. And if you'd like to learn more about abandoned babies and island reversals, go to my YouTube channel under the lessons playlist. Just type in abandoned babies or island reversals, and I have a video there. It's a good video, goes into more depth, a lot more examples, totally free. So check that out on YouTube, Abandoned Babies and Island Reversals. Okay, so Rio up 3.12%. Pfizer. All right. All right, Pfizer, by the way, this blue here, this is called an island reversal because remember, island reversals are 2 or more bars. Island reversal is 1 bar. Well, this is 2. We gapped down. We had 1 day sideways, and then we gapped up. This indicates to me, more likely than not, that this is a short-term bottom. And you can see it was 100% correct. But I did not take this trade because it never came down and filled this gap. But I did enter here on the 19th of March. Why? Well, there was what's called a fair value gap. You can see we have this high here, then we ran up above it. That changed market structure to the upside, and it left a gap between the low of this bar and the high of this bar. You can see I have that highlighted in blue. This is an ICT approach. You can look up ICT on YouTube for fair value gaps, but this is what's called a fair value gap. And I did buy this back on the 19th of March at, what's that? Oh yeah, it's hiding, the blue is hiding it here. 27.36 when it came back down into that gap. Now, my stop on this trade is a close below this swing low, and then of course I have my emergency stop as always 2 ATRs below. I have this red line up here. This is what's called trailing stop level. So when I get into a trade, the first thing I always look for is where's my end of day stop? Well, on this particular trade, my end of day stop is a close below this low. It shouldn't get there. I have my emergency stop 2 ATRs above. So the first thing always I look for the entry. I know where my emergency stop is. I know where my end of day stop is. I want to take care of the defensive parts first. Then I always place my 1.5 ATR trailing stop level above my entry, or in other words, take my entry, add 1.5 to it. If I get to this level, then I go into trailing stop mode, which means if I have a close below a previous bar's low, I'm going to exit half the position. You can see we not quite there. So next week, if we do get up to this level, then in the future, if I have a close below any bar's low, then I will exit half. Now, I always take partial profits when I enter a trade. Always, 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 I add the value of 0.45. Right now, it's 26 cents to the closing price. So right now, the closing price is 27.75. I would take 27.75, add 26 cents to it. That would be my first profit target on Monday. I take my first profit target, add this again. That would be my second profit target. I take the second profit target, add it again. That would be my third profit target. So I always have 3 profit targets for the very next day. And if I get to that profit target, I always take off 10% of however many positions that I have. Like right now, if I have 1,000 Pfizer, then if it gets to my first profit target, I'll take 10% of that. I'll take 100 shares off. If it gets to the second profit target, I'll take another 100 shares off. If I get to the third, I'll take another 100 shares. It's very important to me in my trading that I play offense and defense. The emergency stop, the end of day stop, the trailing stop mode. These are all called defensive moves. But where's the offense? The offense is in taking advantage of the market, giving me something and taking something. Not a lot, but a portion. So for instance, when I bought this here on the 19th, the next day it went up, but not enough for me to take profits. The next day after that, it went up, and it did allow me to take some profits. I took 10% off. Then we came back down, wasn't looking very good. Then we moved up. On Thursday, moved up again for me to take some profits. And then on Friday, I got some at the very, very top as well. So every time I take profits, I lock it in. The market can't take it away from me. I still have shares remaining for a larger move. But the main reason is if the market does turn around and go down substantially, then I have fewer shares and it mitigates my risk. So it's just about playing offense and defense. So this particular trade, not up a ton, but up 1.37% on the remaining shares that I have. All right, let's get to TLT. Oh, and by the way, if you're learning something today that's valuable in this podcast, I really would appreciate it if you could hit the thumbs up button. It helps out the channel a lot. It just lets YouTube know that there's some valuable content here and helps grow the channel and helps keep the channel alive. So if you are learning something and finding something of value today at any point in this podcast, I really would appreciate it if you could hit the thumbs up button. So, okay, here is TLT. So I did enter TLT all the way back here at 9306. What was my thinking? Why did I enter this? Well, for a combination of reasons, and a combination of reasons is always better than just one reason. Let's go back to this highlighted blue bar here. You see it's a big down bar. Well, after this bit, and it makes a low, and this big down bar, then we move up strongly, we change market structure to the upside, and you can see we have a nice big rally. This is called an order block. Your biggest down bar before you have a change in market structure is called an order block. And the potential entry on this is from the high of the order block to the low. If it goes below the low of the order block, then you're done and you've changed structure to the downside. So anywhere in this location here is considered the order block. So when I was talking about it on the podcast here, I said, if we get down into the order block, I will consider getting long. Well, big picture, you can see as soon as it came down into the order block, it did move up nicely. But I waited for a little bit more than just the order block. I waited for another confluence of signal, and it was here on this V2. A V2 consists of three bars, bar 1, bar 2, bar 3. Bar 2 has to go below the low of bar 1's low. Bar 3 has to close above the close of bar 1's close. This is called a V2. You can also have a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. So V1 or V2, this one was a V2 because it consists of three bars. But the thinking was getting down into the blue area here is legitimate just by itself. But when I saw this V2 right as we were in the order block legitimate area, that just confirmed that my basis or my theory of going long was even stronger. And by the way, if you'd like to learn more about V1s or V2s, again, go to my YouTube channel. I have a really good video there on V1s and V2s. There really are really is the bread and butter of my trading. I use them with so many trades to help me make a decision whether to get in and get out. You can see it's called this one's called the V2. See the little V that it makes? That's why they're called V's, right? So go ahead, check that out. It's a really good video. I think it will help you and be interesting for your trading as well. And I guess I should say right now, if you're new to this channel and you see all these different strategies and they look a little complicated, they're really not. You just have to be taught how to use them. And I do teach a private one-on-one course in the evening time via Skype. I've taught people from all over the world for many years, from absolute beginners all the way up to the hedge fund managers. It's a great course. I take you through step by step exactly how to trade each strategy that I use. I've been trading for 28 years now. I have a lot of experience in both trading and teaching. And so if you would like to learn the skill of trading, just send me an email. My email is in the link of the YouTube video here and we can get started. But I know that you'll be a better trader if you were to take this course with me. And I think one of the best ways to learn anything is just one-on-one with an instructor. And that's the reason why I offer it in this format. So if you're interested, just send me an email and we get the conversation started. And I'll talk a little bit more about this in detail near the end of the video. So anyway, order block, we change market structure to the upside. We come down into the order block area. It's more confirmation with this V2 here as well. So I got long here, 93.06. Very next day, we gap up very strongly. And again, if it moves my way more, at least the value of 0.45 ATRs, right now it's 40 cents. But on that particular day, it moved up I hit two profit targets. So I took those off, reduced my position. Then we came down for a couple days. Wednesday moved up again strongly, took another partial profit, and we are here to the orange line, which means we are now at the trailing stop level. So just because I get to trailing stop level doesn't mean I do anything. It just means that I'm in trailing stop mode, which means now in the future, if I have a close below a previous bar's low, I will sell half of the position. So right now, the low of Thursday was 94.32. So on Monday, if we close below the low, I'll simply take off half the position. The remaining shares, because I do take profits here, so I have fewer shares than when I started. So the remaining shares that I have left, if it just keeps going up, I'll just continue to take profits, If we, right now we're at a 54, 56 RSI. If we get to a 65 RSI level, then the 5 EMA will come into play. So if it closes below the 5 EMA, I'll simply be completely out of the trade. If it just keeps on moving up, I'll continue to take partial profits. If we reject the 70 RSI, I'll just take off half of the remaining shares. And then when I get my first close below a previous bar's low after rejecting the 70 RSI, that's when I will be completely out of the trade. So again, these are all the things that I'll teach in the one-on-one course, but they're really not that difficult, right? I mean, if it gets to 65 RSI and closes below the 5 EMA, I'm out. If it rejects the 70 RSI, I'm out of half. If I have a close below a previous bar's low after that, I'm completely out of the trade. So this has been a really good trade so far. This one up 1.62%. All right, UUP. All right, well, this one's not working out as planned. You can see the two bars highlighted in blue. This is an an island reversal. This is a bearish signal, and you can see it did work very, very, very well. I just didn't get that trade. I did get short here on the 21st of March when we got to the bottom of this island reversal. More likely than not, it should have gone down from here, but there were some changes in some of the with the Swiss franc, and it strengthened the dollar. So on abandoned babies, island reversals, remember, I set a 2 ATR stop or a 4 ATR gain. At this point, almost got to my stop. I have a limit or a stop order in. So, on Monday, if we come back down, I have a chance with this trade. If we go up even a little bit more, I will get stopped out of this trade because it'll hit my stop. But it's okay. You're going to have many trades that are losing trades. The main thing is that you don't have any control of anything other than your entry and then where your stop is. So my 2 ATR stops up here, 28.38. It's 1 penny below. My profit target is 4 ATRs below, and looks like this one's probably going to get stopped out, but it's okay because I'm going to lose 2 ATRs instead of 4 ATRs. And I'll have many other trades in the future where I make 4 ATRs instead of losing 2 ATRs. So this one, unless we have a big change on Monday, probably will stop out for a 2 ATR loss on this. But again, it's just one trade out of the next 1,000 trades. I really don't put a lot of energy into any particular trade. It's really nothing to me because I know in the long run, more of my trades are going to work out than I'm going to have losses on. And risking 2 ATRs to make 4 ATRs when you have a good signal and a good setup, I'll take that bet any day. So this one down 0.7%, and if it does get to 28.38, I'll just have to close out this trade. So this one down 0.70%. All right, UNG. All right, well, this one didn't work out so hot tamale. You can see the blue line or the blue band here. This was a order block and a fair value gap. So here we have a low, we have another low. Here we go up, we change market structure to the upside. I talked about this on the podcast. I said if we get to the bottom of this shaded blue area, I will get long. Well, I didn't get long, unfortunately, and look, it ran right up. It did exactly what I thought it was going to do. I just was a little bit more patient to get down here, and I never got the trade. But then in the future, I got long here at 313.24 when it finally did get to where I wanted it to go. And so I got long here at 1488. My stop was a close below the low of this order block and the low of that swing low. Next day, the market took right off. Luckily, I took 20% of this trade off, which was great. Why? Because it ended up being a losing trade, but I did mitigate my losses, one, by booking some profits, and two, by reducing my position size. So, and this is a good example of why it's so important to take profits when you do have them, especially if your trade ends up being a loss like this one. So first day after I bought, went up, hit two profit targets, took 20% of the trade off. Then we just kind of meandered sideways, went up a little bit, but not enough for a profit target. Came back down, just held that blue shaded area. But then on Wednesday, it broke down, and I did have to get out for a loss of 2.98%. So unfortunate, but it's never fun to take losses, but in the long run, to keep yourself into trading, you just have to do it. I mean, look, the next day, it did go up a little bit. And if I would have kept it, yes, I would have mitigated my loss. But it's better just to take your loss, get on to something else, and just forget about it. So this one down 2.98%. So real quick recap on the dailies, open and close. Rio up 3.12%. Pfizer up 1.37%. TLT up 1.62%. UUP currently down 0.7%. And UNG had to take the loss for 2.98%. All right, let's go over to the weekly trades. Okay. You know, if you've listened to this podcast before, I've said many times you have to be very patient with your winners and very impatient with your losers. So if you have a loser and it closes below your stop, just get out quickly. Just get out of it, get done. Look for a better setup. On the other hand, if you have a winning trade, you need to be very patient with those open profits. I know it's hard, but you need to be patient. And that's why I keep going back to you need to have a process that tells you what to do. And this was a huge trade for me. And the only reason I'm still in this trade is because my process told me to be. So I bought this all the way back about a year ago. Over a year ago, March 24th, 2023. Why did I buy this? Well, this is called the deep dip buy entry. The purple line here is the 250 week moving average. Remember, these are weekly trades, so I take the weekly bar closes on Friday, so I take my entry on a Friday. That particular week, we went below the 250 week moving average and then closed above. I got long here 30.71. I placed my emergency stop 2 ATRs below. My end of week stop would simply have been a close below the 250. I placed my 1.5 trailing stop level 1.5 ATRs above my entry. And of course, if it moves up, I take partial profits. So the next week it moved up enough for me to take some partial profits. Next week, not much. Next week moved up again, enough for me to take partial profits, and I did get to trailing stop mode, which means now in the future, if I have a close below previous bar's low, I'm just going to get out of half. Well, we went down, but we never closed below any bars. Then we moved up a little bit, and then this here on the 23rd of June was our first close below a previous bar's low. I got out for a gain of 6.4%. Then we had another 5 or 6 weeks to the upside where I continued to take partial profits as the market gave them to me. And then we had this big move down over 3 months to the downside. And look at this bar here on the 27th of October. During the week, it closed below the 250, but then it barely closed above the 250. That kept me in the trade. Had it closed below the 250, I would have been out of the trade. Still at profitable levels, mind you, but I would have been out of the trade. But it didn't, so it kept me in the trade. And then the next week, we had a huge move up, took partial profits. This week here, another big move up, took partial profits. Took partial profits here, took partial profits here. And then as we are moving up and moving up here, it moved up, but not enough for me to take partial profits. It's fine because the remaining shares I have are still going up quite nicely. But right now we're at an 83.39 RSI. So remember before I said if you get to a 65 RSI and then you have a close below a 5 EMA, that is going to get me out of the trade. So you can see the 5 EMA, it's kind of stuck here. It's this very thin blue line right above the third ATR channel. Basically, if I have a close below that 5 EMA, I'm simply out of the trade. That will be out of the trade. And this particular trade currently up 27.14%. And if it closes below the 5 EMA, I'm simply out of the trade. But this is a really good example on this trade of having a process that tells you what to do, avoids having impulsive decisions, and not all trades are going to work like this, but every once in a while you are going to have a trade to work like this. And trust me, having a big outsized gain like this will pay for many, many, many little small losses that you'll have in the future. So remaining shares on XLF up 27.14%. Johnson & Johnson, another weekly trade. Okay, here we go. Took Johnson & Johnson back here on the 15th of December. Why did I take it? Well, take a look at the blue line here. This is the 200-week moving average. During the week, it went below the 200, closed above the 200-day moving average. In addition to that, look, it's a V1. Bar 1, bar 2. Bar 2 goes below the low of bar 1's low, closes above the close of bar 1's close. So I had a V1 and an intra-week rejection of the 200-day moving average. Remember, look for confluences combinations. So I did get long here, 154.27 with an intra-week rejection of the 200-day moving average and a V1. So this is technically a deep dip buy stock trading strategy, long at 154.27. My end of week stop is simply a close below the 200-week moving average. Here's my emergency stop, 2 ATRs below. 1.5 ATRs above is my trailing stop level. Next week, moved sideways, but didn't close below the 200. Next week, went up a little bit, didn't close below the 200, kept me in the trade. Next week, we moved up strongly enough for me to take a little profit off, profit targets. Next week, moved up again, did get to trailing stop level, not enough for me to take profits, but did get to trailing stop level, which means now if I have a close below a previous bar's low, I'll get out of half. This happened on this week. You can see it closed below a previous bar's low after reaching trailing stop level. I did get out of half the position for a 3.33% gain. Then for a couple weeks we went down, then we had a big bar up again where I took more profits, a couple weeks sideways motion. Before we started to move down, I took some profits off here because it was 0.45 ATRs above the previous bar's close. So I did exit more and lock in more profits up here. Then we started to move down. Last week, I thought we would possibly close below the 200-day moving average and I would be out of the trade, but it held. So the remaining shares on this particular trade up 2.46%. So not so bad. But again, this was a deep dip buy stock trading approach with the intra-week rejection of the 200 and a V1. And last trade on the weeklies is CCJ. One of my favorite trades, return to value V2. Return to value, let's look at the green line, the top green line here, the bottom green line here. Anywhere in this area is called the value zone. And we want to buy in value, somewhere in value, and sell above value, or buy below value and sell in value. What a lot of people do is they buy above value, really, which is not the place to buy. You can see if you bought here, you had to withstand some losses. If you bought here, you had to withstand some losses. So this is called a return to value V2 in this case. Anywhere in here is the value zone. We were above the value zone. We returned to value, right? That's the name of it. returned to value, V1 or V2. We were above the value zone. We returned to value. We had some sideways motion, and then we had our trigger, V2. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low, closes above bar 1's close. This creates the V2. So basically, we were a little overbought here. We returned to the value zone. We waited for a legitimate trigger, which is a V2, and I did get long at 42.80. So I positioned size correctly here. I placed my 2 ATR stop below. My end of day stop on a V1 or V2 is simply a close below halfway of the washout bar, in other words, the V2 bar. So here, bar 1, 2, 3, bar 2, halfway of this bar 2 is my stop. So next week's, if I close below, it's 40.80. If next week, if I close below halfway, then I will just exit the trade. Studies have shown that if you close below halfway of that V1 or V2 washout bar, more than likely you're going to head back down. If you hold above it, more likely you're going to head back up, and that's why I'm using this. So this particular trade, from entry to current price on the remaining shares, is 1.26%. So real quick recap on the weeklies. XLF, again, deep dip buy approach. XLF up 27.14%. Johnson & Johnson, deep dip buy approach off of the 200 and the V1, up 2.46%. And then CCJ, a different strategy, return to value, V2 up 1.25%. All right. And by the way, I use the deep dip buy approach a lot, and of course I do teach it in my one-on-one course. But the one-on-one course it's more expensive because it's one-on-one, and I teach you all 5. But if you're not in the financial position to take the one-on-one course, go to I have a link, udemy.com, where I have a 9.5-hour course on the deep dip buy approach, where I teach you step by step exactly how to trade that approach. It's very, very affordable, 9.5 hours of video, and the link's in the description. But how to trade the deep dip buy approach on Udemy. Okay, so so we covered the weeklies, and there we go. So yeah, all pretty good, except for UUP's gone against me, and then UNG didn't work out. But the rest of them have been positive, which is great. You're not always going to have profitable trades, but the point here is when I'm wrong, I get out quickly. You can see the trades that I was wrong on, I got out just as soon as they told they were not going my way. The ones that are going my way, I'm just patient. I'm just sitting in, like the XLF trade that I've been in for over a year, and that is proper trading right there. All right, let's talk, before we get over to taking a look at the trades that I'm looking at for next week, let's talk a little bit about trader psychology. It is the most important skill in trading. This is my good friend Stephen Burns. You can follow Stephen Burns over on Twitter at @SJosephBurns. Steve is a great trader, a great author. He's written so many great books. He's been a mentor and a coach for me over the years. And do yourself a favor, go over and read one of Steve's books. You can just order them on Amazon. But Steve says trading isn't about predicting the future. It's about preparing for its many possibilities. And this is really true. In trading, a lot of people try to predict the future. It's not about trying to predict the future. It's about waiting for a setup or a pattern that tends to go one way more than the other way. Not going to be 100% of the time, but certain patterns tend to go one way more than the other. And you always hear people talking about, okay, you need to find an edge. Well, that is what finding its edge is about. It's about finding a pattern or a setup where it's more likely to go this way than that way. And over time, if it's more likely to, then that's how you make money. But again, you need a position size, and when you're wrong, get out quickly. All back to a process. Trading isn't about predicting the future. It's about preparing for its many possibilities. When you enter a trade, it can do all sorts of different things. It can go your way, it can go against you, it can do nothing. But it comes back again to having a process, having a set of rules, if-then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. Keeping in mind asymmetrical risk to reward ratios, position sizing based upon the current market volatility and your account value size. You have to factor all of these things in. It's not just about hitting buy and sell when it feels good, right? If you want to be in this for the long run, you want to do it the right way, and you want to be profitable over many, many years and stay in the game, you have to find a good process that factors in all of these different things. That's why so many traders lose money, because they're missing a component of the whole process of what you need to do. And this is what Steve's talking about, is preparing for its many possibilities. So trading isn't about predicting the future. It's about preparing for its many possibilities and knowing what to do regardless of what the market does. So thank you, Steve. Always appreciate your posts and your books and your teaching. And please check out Steve Burns to learn more. Okay, let's head over to what I'm looking at next week. Now, again, these markets are not where I need them to be. This is the part of the art of trading, is being patient and waiting for your market to get to where you want it to get. So when I look at Adobe here, by the way, this would be a potential deep dip buy setup. 3 key levels here: 200-day moving average, purple line is the 250, and the orange line is the 300-day moving average. This is the level that I am looking at right now, is the 300-day moving average. This is a key level where large financial institutions and savvy traders will come in. They don't always work, but you can see I drew the blue box here. This is where I need Adobe to get to. You can also see we have the negative third ATR channel. This is the negative third. 92% of prices tend to stop going down here. So the confluence, excuse me, I have a little cough after got off my flight from Colombia. But we have the 300-day moving average. We have the negative third ATR channel. They're converging right at the exact same level. Does this mean they have to stop here? No. It can certainly go down more than this, but this is getting to the area where it gives me a good structure and a good risk to reward ratio. In addition to that, we have a double bottom bullish divergence. Look at the low here. Look how deep the bars are, the red MACD bars are. Look here, we're lower than here. These red MACD bars are not as deep. This is called the double bottom with a bullish divergence. This is what I learned from studying one-on-one with Dr. Alexander Elder. One of his favorite setups. He thinks that double bottoms, bullish divergences is the strongest technical indicator in trading. So yes, we have a double bottom bullish divergence, but even though you have a double bottom bullish divergence, you still need an entry signal. You still need something to help structure your trade. And for me, next week, it would be some kind of rejection of the 300. You can see over here on the 15th, we did have a rejection. During the day, we went under, closed back above. I did not take this trade, but it did work for a while. But I want to see it try to reject it again. And I think the entry here would be better than here, because this is just a rejection of the 300, where here, if you reject it, you're not only rejecting the 300, but you're rejecting the negative third ATR channel as well. Make sense? So if it comes down to the 300-day moving average, which is 492.09, so it's still about $12 lower, but if it does go down here, I'll consider taking the trade. And by the way, I have 5 symbols here that I'm going over. It's there's potential that all 5 of these could trigger on the same day, but does that mean I'll take all 5? No. If all 5 triggered on Monday, I would only take one of the 5. And how would I do that? Well, how would I pick that one? Which one had the most confluences of signals? Which one had the best risk to reward ratio? Which one looked better on multiple time frames, even higher time frames? Which one had the best relative strength compared to the rest of the market? These are very important. how to narrow down what is the best trade. When you have multiple, how to narrow that down. Again, which one had the best risk to reward ratio, which one had the most confluences, combinations of signals, which one looked better on multiple time frames, and which one had the best relative market strength. And again, this is what I teach in my one-on-one course, exactly how to do this. And this is the real art of trading, of narrowing multiple candidates down to the best one. But I like Adobe, ADBE. I like Adobe here. Just have to wait and see. It might just take off to the upside and I lose the trade, and that's fine as well. But I quite like this trade, but I still need Adobe's market price action to reject this 300-day moving average for me to consider. But I like this as a potential trade. RBLX. All right. Well, a few days ago would have been a legitimate entry on RBLX because we had a close under and a close over the 200. I did not take this trade. But what I liked about this on Thursday is we took out this swing high. This is important. We finally took out a swing high. And so you can see the highlighted blue box I have here, just waiting for a pullback back to the 200-day moving average again. But the reason I would really like this one, if we come back and we reject the 200-day moving average, is that prior we just took out this swing low, which in a way changes market structure to the upside. And when you change market structure to the upside, I like to buy that first dip. And so a first dip after changing market structure back to the 200 would be a really good place to do that. So if we check back, have a close under over the 200, an intraday rejection of the 200, or a bounce on RBLX, especially in light that we just took out this swing high, that would also be a consideration for me. Right now, the 200 is at 37.08. So it has to go down a little bit more than $1, but this would be a potential as well. Tesla. All right, well, Tesla did have a good under 30, over 30 trade here that worked out, had a deep dip buy. I did not buy this one, but what I'm looking for here is what's called a higher low V2 in the value zone. I talked earlier about a return to value V1, V2. This is the opposite. This is when you close below the value zone, you come into the value zone like we have. Here we closed below, here we moved in. Now I need a bit of a pullback, which it's doing, and then any type of V1 or V2 in the value zone. Let's say Monday, we come down below this Thursday's bars low, reverse, let's say we open up down here, reverse back up. That would be a V1 in the value zone that is higher than the previous low. One of my very, very favorite approaches, higher low V1s, V2 in the value zone. So I don't know what the future is here. It might just continue up, in which case I wouldn't get the trade. But suffice it to say, next week, if we go down and reverse back up with the V1 or a V2, and it is in the value zone, I would consider taking that higher low V1 or V2. And MACD is green here, by the way, which makes a higher low V2 even more likely to be positive when MACD is positive as it is. So on Tesla, just looking for a higher low V1 or V2 in the value zone. If you'd like to learn more about V1s, V2s, just check out my YouTube channel, V1s, V2s. Natural gas. Okay, so I did have that losing trade on natural gas, but you know what's interesting is that we have another abandoned baby. This is now an abandoned baby here. Why? Well, we gapped down. Did we gap down? We certainly did. I know because I was long. Did we gap up? Very next day, we gapped up. This is now an abandoned baby. Technically, this would have been a legitimate entry signal even on Thursday because it closed the gap. I didn't notice it because I was trading other things. So technically where it is right now is a legitimate new entry. So I'll just have to see what happens next week. Halfway of this abandoned baby here would be a really good entry point. You can see on Thursday, that's exactly where it caught before it bounced. If it revisits that area, I would consider getting long natural gas as well. So this one's very hard because I can't really say it's going to do this or it's going to do that. All I know is there's an abandoned baby here, so it does give possibilities to get back in. But suffice it to say, for this particular podcast, if we go back and revisit the halfway here of the abandoned baby, I would consider getting long again based upon the abandoned baby. So, and if that's the case, 2 ATR, stop to the downside, 4 ATR to the upside. But we'll just have to kind of monitor this one and see. And then last but not least, Walgreens, WBA. Okay, this is really interesting here. I talk about fair value gaps. This is perfect. Look, we have a low. We ran the low. And then we had a huge move up here, which changed the structure to the upside. We are now in a bullish market structure. That happens when you have a low, you run the low, and you take out the swing high. And it certainly took out the swing high. So in my opinion, I could be wrong, but in my opinion, market structure for WBA has now changed to the upside. And you can just see from the chart, something has changed. And earnings was on Thursday, and there was something about it that the market liked, and that's what took off. Does that mean I'm going to chase it up here? No, I'm not going to chase it up here. But there are multiple areas here that would be legitimate buy entries for me if we came back down. Because I think that the short-term lows are in. I highlighted here in the blue several levels. One, this would be the low of the fair value gap. I don't know where the fair value gap is until this opens on Monday, but I believe, more likely than not, that it will probably open somewhere up here. So you'll have this huge fair value gap from here to here, but because we don't yet have that bar, I know this most likely will be the low of the fair value gap. 2109. In addition to that, these previous highs, which were resistance, will now be support. Another confluence is that when you have a big bar up like this, halfway, return back to halfway, is going to add some support. So I am going to be looking, me personally, anywhere from 2114 to 2109 in the shaded blue area. This is what I would be looking for a pullback. And after you have these big moves up, very often you do have temporary pullbacks before you start another large leg up. This one might just continue up. I missed the whole thing. That's fine. But again, I just have to look at this on the weekend and go, ooh, this is the area that I would like. I think this would be a strong area to give me a better chance of it moving up than down. But it may not come down. I may just completely miss the trade. But if it does come down, I will consider getting long here somewhere between 2114 and 2109. My stop would just simply be a close below this swing low. I also put the green line here. You can see here's a V2. Bar 1, 2, 3, 2 goes below bar 1's low, 3 closes above here. There should also be some major support here at halfway at this V1 bar. I don't know if it's going to quite get this low, but if it does, I would certainly consider that, because it would make the risk to reward ratio of the trade very, very good. So the two highlighted green areas is where I'm looking here, halfway of this big bar up, bottom of the fair value gap, support of the previous resistance, which is now support. So if it does come back, I think this 2109 to 2114 would be the most likely area that it would come back to, and I think this would offer really good risk to reward ratio. If it completely dumps down here, then obviously somewhere about 2044. So I think there's some areas, potential opportunities on WBA here because of this strong dramatic shift to the upside, but just need to have a pullback. So those are the dailies. Hope that was helpful, and let's switch over to the weeklies. Okay, and again, on these weekly trades, these could all trigger at the same time. They really could, and if they do, I would just have to narrow down to the best one. And again, what's the best one? The one that has the most confluences of signals, the one that has the best risk to reward ratio, the one that looks better and shows some support on a higher time frame, and which one is stronger or weaker, depending if you're long or short, compared to the rest of the market. These are all the math that I factor into when I have multiple candidates and how I'm going to narrow it down, okay? So Adobe here, 200-day moving average dovetails exactly with the negative third ATR channel. This is a nice confluence. This is down at 478. Yeah, this is down quite a lot, 30 points or so. But I don't know if it's going to get there, but if it does and it rejects this 200-week moving average, either goes below it during the week, closes back above it, that would be an intra-week rejection of the 200, or it bounces, then I would consider, because then it would give me a good risk to reward ratio based upon two important levels: 200-week moving average, negative third ATR channel. Alternatively, you have some levels even further down here, the 100 and the 250-week moving average all the way down here. Of course, if I had my preference, I would buy down here because these are further down. But right now, that 200 and the negative third ATR channel makes sense to me, and if it goes lower, the 250-week moving average makes sense to me as well. Anheuser-Busch, Budweiser, kind of the same story. Deep dip buy again. 200-day moving average is down there. You can look to the left. Last time we went under the 200 and over the 200. The 200 was supported, and it did respect the 200, and you had a nice several month trade off of the 200. So if it comes back down to this 200, what does that mean? Does that mean it has to respect it? No, it doesn't have to respect it. But when you are coming down to a major moving average, I like to look in the past to see if that moving average was respected last time, and it was respected last time back here in November of 23. So it gives a little bit more of a positive bias if it's respected in the past. So if Budweiser does come down, it's at 59.09. We're at 60.78. So I don't know if it's gonna get down here, but if it does, I'll consider getting long Budweiser. INDA. All right. Well, this would be a potential short position here. You can see the area that I highlighted, INDA, and the strategy on INDA here would be an order block. Remember the order blocks I talked about, the bullish order blocks I talked about on bonds? Well, this is the opposite. This is the highest bar in the move before you had a market structure change. Market structure change came here on the 15th. We had a high, we went higher, and then we had a strong move down that took out the swing low. This changed the market structure to the downside. So on an order block, the entry point for me to get short would be the bottom of the order block here, all the way up to the top of the order block. And then if it closed above, then I would be out of the trade. So again, or just to kind of condense this, anywhere in this blue area here, somewhere from 51.67 to 52.46 would be a shortable area for me. My end of week stop would simply be a close over this high, and as always, I would have my 2 ATR stop above that. You know, it's hard to short into markets that are going up like this, but this is a very well-defined area for me. High, low of the order block, anywhere in here using this strategy is a legitimate short, only because we had this big move down that broke this market structure. So the way I view this market is that, yes, it is going down because we broke market structure. So if you have a rally in a market that you believe is going down, that is the short, right? Buy dips in an uptrend, sell rips in a downtrend. Well, this move down here changed the market structure to the downside. That is why I am looking to sell this rip or sell this rally into this well-defined area of order block. So somewhere between 51.67, 52.46, I will consider getting short INDA. Tesla, TSLA. All right, deep dip buy. What am I looking for? Well, I'm looking for the 300-week moving average right here. You can see the 200 didn't hold, the black. The 250 didn't hold, the purple. Well, is the 300, the orange, going to hold? I don't know. But if it does get down here, right now the 300's at 158.41, so it's down there substantially. Kind of big moves down here. I don't know if I would get long here, closing above the 250. Just ideally looking in this trade, I'd feel much more comfortable just buying or considering buying Tesla if we move down to 158.41 and show some kind of bounce or intra-week rejection. And then last but not least is VIX, VXX. Had a trade here back on the 8th of June, had a nice under 30, over 30 in V2. Didn't work out for me, but I am still bullish on VIX actually, which is the volatility of the market. I still need a new entry signal. This would be a deep dip by under 30, over 30. Right now we're at 28.54. So the entry signal next Friday, if it moves up, is if it closes above the 30 RSI. And if it does, then that would be a legitimate deep dip buy. If it does close above the 30 RSI, we will also have a V2. So we'll have a combination of indicators. So those are the potential trades for next week. Just quickly, want to take a look at some of the indexes. Let's look at the Qs. See where we're at on the Qs. I'm quite bearish on the market in general right now. And why am I bearish? Well, look at this chop and this craziness that we've had. We had this strong move up that just kept going up and up and up and up. Well, now you can see something has changed. But from a MACD perspective and a momentum perspective, this looks extremely bearish to me. Look at these highs here. Look at the green MACD bars. Very high. We go higher. We have green bars, but they're lower. We go higher. We have green bars, but they're lower than even before and before. Then we made another high here, no green bars whatsoever. So all this means is every time we move up, it's coming from a MACD perspective, an ATR perspective, RSI perspective. The momentum is running out of buyers. And if you run out of buyers in the future, all that you can do is go down. So, I have my thoughts on the economy and the macro indicators and the micro indicators, what's going on in the market. But really, the charts and the MACD are showing me a lot. When I look at this, just because I've been doing this so long, I think this market's going down. I really think this market's going down just because we go up and up and up and up and up, and momentum's it's going down and down and down and down and down. So please be careful, everyone. The indexes are showing that we're kind of running out of some gas. And if we run out of gas, then, it's potentially we could have a pullback. And we are due a pullback as well. I wouldn't be surprised we have a 5, 6, 7, 8, 9, 10% pullback. So please be careful. Try not to get caught up into reading headlines and what the media is telling you. They, of course, just trying to cheerlead the market up, but look at really what the market's telling you. And to me, the market is telling me that every time we have a big down bar, it comes on high volume. If we have a big up bar, it comes on low volume. We have all this slowing of momentum to the upside. So yeah, I am quite bearish, and that's why I want to keep very tight stops on my longs. So I hope this was helpful for today. If it was, if you could hit the thumbs up button, I'd appreciate it. If you're interested in my one-on-one courses, my email is in the link of the description. I'd love to work with you. It's really fun. The course is 15 hours that we would work together, 5 sessions, each session 3 hours. And I teach you everything that I know about trading. I will teach you all of my 5 trading approaches. The cost is $1,750. I know it sounds like a lot of money, but really for what you get and the attention that you get and what you're going to learn, it really is money well spent. I mentioned the Udemy course. That's very inexpensive. It's somewhere between $12 and $40 for the entire course. The Udemy link is in the description of the YouTube video. And I always like to leave off. Try to go out and do something nice for someone today. try to do something nice for a human, try to do something nice for an animal. It will come back to you, and the animal or the human will really appreciate it, and maybe one day when you need it, it will come back to you as well. But it's just something that I try to do every day. One nice thing for an animal, one nice thing for a human. It really would make the world a better place if we could all do this. So I hope you found this helpful, everyone. It's nice to be back in America, but I really do miss the sun and the warmth and my girlfriend and my dog. So yeah, I kind of came home with a bit of a heavy heart, but I'll go back again. And if you get a chance to go to Santa Marta, Colombia, go. I think you'll really enjoy it. And if you have any questions or comments about anything I mentioned here, feel free to put them in the comment section. I'll do my best to get back to you. And so yeah. Thanks for coming, everyone, and God willing, I will see you next week. So take care, and on the way out here, I have to run the U.S. legal disclaimer. Thanks again, everyone. Take care. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.